Hello and a warm welcome to another edition of Econoday Unplugged. It's Tuesday, the 10th of May, 2022. Mark Pender's on the US East Coast, and I'm Jeremy Hawkins in London. Last Wednesday, the FOMC raised interest rates by more than 25 basis points for the first time since 2000. A day later, the Bank of England hiked by another 25 basis points, despite warning that recession is probably just around the corner. And even the ECB is now dropping hints that it might, at long last, increase rates in July. But at the same time, expectations for global economic activity continue to be ratcheted down as a combination of high inflation, increased borrowing costs, squeeze real incomes, and the war in Ukraine and shortages of raw materials and labour stifle output. So the gap between growth and inflation is widening. It shouldn't be too surprising then that financial markets remain very volatile and risk aversion dominates investor sentiment. Almost certainly, global interest rates are further to rise. While it remains unclear just how high they're going to go, it's a prospect that leaves equity and bond markets looking very vulnerable, and at least some central banks more than a little worried about what's happening to their currencies. So let's kick off with Mark then and see what's going on stateside. Well, I suppose we've got to begin really with the FOMC. In a nutshell, what did that tell us about policy last week?
Well, the Fed is in a little bit better spot. The currency, the dollar strength is really the issue here. We had these big trade numbers and these vast amounts of imports happening now. We have a lot of demand, so the U.S. isn't quite as weak, or that relationship with output isn't a big concern, as big of a concern it is with the Fed. Powell last week in his press conference was definitely playing down the risk of a recession here. They did raise rates by 50 basis points, taking their target to 7/8%. How high that goes, like you said, we don't know. Maybe 2% or above, something like that. I don't know, maybe to 3%, somewhere in that category right now, looking at. If they do a series of 50 basis point hikes for the remaining meetings this year, they're going to begin in next month running down their balance sheet. It stands at just almost 9 trillion right now. They'll be doing 100 billion a month. So, and they wanted to do that pretty quickly. So we'll see how that scales. But right now, recession isn't really the risk. More the risk, I think, is what's going to happen. Not to growth. Our PMIs have been very strong. And real quickly, to throw in China right now with COVID, and their PMIs are below 50, which is contraction. That's not what we're seeing here. Ukraine hasn't had that effect here, or COVID. So we're seeing really quite strong growth, but what we're seeing is an evaporation of available labor. So we had a decline in the employment report last week. There was I believe it was a 0.2 decline in the participation rate to 62.2%. So that's been actually going down. That has never recovered from the beginning of the pandemic. Unlike other economies, participation here is really low, and that spells the risk of inflation. And we had our average hourly earnings were at about 5.5. We're on consensus at 5.5% on the year last year, which is really the first actual definitive inflation reading that we have for the month of April. We're going to be getting, like you were saying, the CPI tomorrow. And it's mixed. The Econoday's consensus is a very mild-looking 0.2% monthly rate, which would be down a full percentage point from March. But the core rate is actually consensus here is up 0.1 to 0.4, which is not, extremely super high, but still pretty high. And the annual rate is seen coming in at 6%, which would be lower than the prior month for the year-on-year reading. But it's really that monthly reading that's more important because it's a more immediate comparison. So also, tomorrow we're going to be getting the first anecdotal reading on May inflation, and that's going to be from the Atlanta Fed and business expectation inflation at that on that level. That has been at an all-time high of a super elevated 3.8%, which for this reading is extreme. How that goes, so we're going to get two different readings tomorrow. We're going to get the actual definitive consumer reading on April, and then we're going to get an early reading on what businesses see for their own situation in May. And I think, and we had with the wages going up, I think part of what's going on is how high will that Fed target have to go. They are committed. The Fed is committed to fighting inflation, doing it now, sooner, not later, as Powell was stressing. So they're going to be very aggressive, and the U.S. has the luxury. Unlike the UK, for instance, there is no talk at all about any contraction anywhere. Of course, we don't have our quarterly, the Fed, they did their last quarterly numbers in March, and they didn't include any Ukraine effects. And there's been a lot of new things that are going on. So we'll have to wait to June to get another set of numbers. But there's no hint whatsoever anywhere of any kind of recession here.
Okay, let's go back to just the wages side of it and expected inflation. I saw we had the New York Fed survey out for April yesterday. Median 1 year ahead inflation expectations there dropping from 6.6% in March down to 6.3%. You said also that this week we'll get the headline CPI out, which should suggest that inflation or measured inflation is actually starting to decelerate as well, at least on a year-on-year rate. Do you think we're getting close to the top of US inflation, or do you think there's more bad news in the pipeline?
It depends, I guess, to a large degree, or at least the perceptions of that will depend to a large degree on labor, on the cost of labor. And that, by all indications, that may very well go up. I mean, the amount of employment growth here is pretty astounding. 428,000 on the non-farm payroll, which is a little bit above the consensus in last week's report for April. And there's just no signs of any. It's just strong across the board. And the amount of employees, the stock of available employees keeps going down and down and down. And I want to put the listeners' attentions to the JOLTS report, which lags by a month. But and this is a number that Jerome Powell points to a lot. This is job openings here. And in March, it was 11.5, over 11.5 million openings. These are all-time records, and it's going up in several hundred thousand a month, even at the same time that employment itself is going up. And so what's happening is the number of available workers who want a job keeps going down to 5.9 million in the last report for April, which was last week's report. And this number was as high, just a few months ago, it was at 7 million. So you're drawing down that at the same time that openings keep going up and up and up. But there's a lot of distortions going around right now with the U.S. I don't know, but we're getting service jobs coming in, which are lower wage jobs that may limit the inflation effects. Also, we have, U.S. numbers are highly seasonally adjusted, and this pandemic for the last 2 years has got to have the statisticians scratching their heads. There's no reference in the history to find out, what exactly, if they're going back 5 years, for the last 5 Aprils, or for the last, in the data, or whatever the last 5 Aprils done. Well, the last 2 of them have been in a pandemic, especially the one a couple of years ago, right? So how are you're going to throw that number out? What are you going to do? So the actual, it's hard to read the numbers going on. The productivity numbers last week were just shockingly bad. It was the worst productivity number the U.S. has ever seen. I mean, since the data began in 1947, it was even worse, but that was after World War II, if you remember, and everything was skewed. There was a huge drop in employment and stuff at that time. So the total mayhem in the labor market after World War II, and this is the comparisons now we're getting. So the numbers here are hard to read, but if you just stick with the PMIs for right now, where and you're just looking at those numbers, which is a simple percentage of businesses who say business is better than it was a month ago or worse than a month ago, those readings on the whole are looking pretty good. So their business is, I think, pretty up. But I think it's kind of hard to read everything right now. But what's not hard to read is that that we're drawing down the available labor. We continue to draw it down. We continue to draw it down. And, unemployment, that's another factor. Unemployment rolls are down over here. Our people are coming off unemployment benefits, so they'll be coming into the workforce. Maybe that will help. I don't know, but there's so many different X factors here that it's kind of hard to read. But it's not hard to read what the Fed is going to do. The Fed is going to raise rates, and that's pretty much it.
Okay, that probably covers most of it. But one last thing I'll ask you about, and that's the exchange rate. As you mentioned, we do have a particularly strong dollar at the moment. The dollar index itself is trading at very high levels. And are we getting to the stage whereby the Fed might have any concern about a strong dollar? Or is it the case that despite its relatively closed US economy compared to, well, something the likes of, say, Europe or Japan, it's going to perceive strong dollar is good news for helping to keep inflation down?
Well, yes, the dollar definitely is not a major factor in policy in the policy debate, and the strength in the dollar, I think, its negative effects on foreign economies is probably the greater risk than what its effects are on the U.S. itself. But the U.S. trade picture is also completely distorted right now. We had a deficit in March of it was 120 billion, and all the levels. Exports were good. Exports were going up, but imports, the demand for imports, the U.S. demand for imports, and that's the sign. And that's not, further confirmation of the strength of the U.S. economy right now. And demand for capital goods was incredibly strong. That's a business indication. Demand for consumer goods, which the U.S. is trade dependent on, was very, very, very strong. So we're drawing in these comparatively low-priced imports, and we're just buying them en masse. So it's confused. The data right now is very, very confusing. There's a lot of different issues at play right now with it. But the dollar is not. It's not a point of major discussion, whether in the policy statements or in the policy discussion.
Okay, muchly for that. I guess from my side, at least briefly stick with the currency markets, where the dollar is becoming something of an issue for discussion. Indeed, not just as far as Europe's concerned. Clearly, we're currently living in a time of rising US interest rates and a strong and indeed still strengthening dollar. That's got all sorts of nasty implications for the emerging markets. And indeed, looking at India yesterday, we saw the rupee hit a record low against the dollar. And the Reserve Bank of India was obliged to intervene to try and support its currency. Now, we're not quite at that stage in Europe yet, but nonetheless, if I switch across to what the ECB is doing, I've had some comments coming out there suggesting that, although of course the ECB very much sticks with the view that it doesn't have an exchange rate target, nonetheless they are plugging the fact that the euro being too weak would jeopardise their price stability target. So they'll certainly be keeping a wary eye on it. And it's been, I suppose, just got sentiment interested enough to the effect that there has been some talk about the possibility of some form of intervention to actually prevent the euro from going down any further. Now, I guess that realistically, at current levels, where are we? As we record this, euro dollar's trading at about 1.055, so about 5% or so above parity. I think if we were to see intervention coming out of the ECB and the FX markets, really it'd want to be some kind of concerted move, certainly with the Fed, probably the Bank of Japan as well. And I guess at this stage, although certainly a stronger euro would help to put some kind of cap on inflation, it is the case that there's a relatively small feed through, it seems, from what's happening to import prices or by the exchange rate and the actual level of prices in the Eurozone itself. Just looking at a paper published from the ECB back in September 2021. And that basically came out the idea a 10% depreciation of the euro would only increase the inflation rate in the Eurozone by about 0.4 percentage points. So yes, there is an impact in there, but it probably means that the euro is going to have to fall a good deal further yet before the ECB would actually significantly consider intervening in the FX markets.
Wouldn't they want to raise, I mean, before intervention, wouldn't it be easier just to raise rates?
Well, that is certainly one way around it. And of course, one of the reasons why we've got such a strong dollar and such a weak euro is because the ECB has been one of the most obvious laggards amongst the central banks in terms of tightening. But the problem for them, of course, is the fact that you've been talking up the US economy, but when you look at what's been going on in Europe, the first quarter preliminary flash GDP numbers for Europe show quarter-on-quarter growth of just 0.2%. Within that, Germany was 0.2%. France didn't grow at all. The Italian economy actually shrank by 0.2%. Now, part of this is due to the early effects of the war in Ukraine. But then, of course, the second quarter impacts from Ukraine is going to be even steeper. So there's a real issue at the moment for ECB in the sense of what's going on in Germany. The German economy is slowing rapidly now. The March industrial production figures were down almost 4% on the month. That's its worst performance since April 2020, so just after COVID arrived. And we've even got industrial output as of March almost 8% below where it was before the pandemic arrived. Orders are falling out of bed, so there's an extremely good chance we could see negative growth in Germany in the second quarter. Italy is expected to fall into technical recession in the second quarter. And most of the Eurozone is really struggling. So can you raise interest rates? Answer that now, though, appears to be yes. I said in the intro, there has been some indications now that the ECB are starting to think, well, enough is enough when it comes to inflation. Well, up at around 7.5% now, so miles above the 2% inflation target. And it does seem that the hawks are getting their way. So I guess the way the market's positioned now, there's more and more focus on the possibility of a rate hike, probably only 25 basis points. I don't think it'd be a big one by the ECB when we get into the meeting, in July time. So after they update all their economic forecasts at the June meeting, could well see the first of what might be a number of interest rates coming through in July.
So wait a minute. So they have a meeting. When's their next meeting?
The next meeting will be on June the 9th. And that will be,
then one after that will be in July.
The one after that will be July the 21st.
So June, you don't think there'll be the expectations will be for a rate hike will be centered in July and not in June?
Well, the way forward guidance stands at the moment, they can't start raising interest rates until they finish their quantitative easing, and that's not due to be completed. Taken literally from what they're saying until the third quarter. Now, of course, it could be right at the beginning of the third quarter. So at this stage, probably the earliest they could raise interest rates would be in July time, say probably at that particular meeting. But it's difficult because now, however you look at it, it's easy perhaps for the Fed to raise interest rates in the sense they've got a strong background to the economy. The Eurozone was just been saying, apart from the labour market, which much akin to labour markets almost everywhere at the moment, remains tight and is still tightening. Everything else really suggests that economic activity is slowing down, and perhaps slowing down quite quickly. So it's going to be the case, I think, that with reluctance, we will see the ECB hike interest rate probably in July time, and we might see another interest rate hike before the end of the year. But compared to what's it seems going to be the case for the likes of the Fed, it's going to be lagging well behind. So I mean, I think the idea of euro versus dollar hitting parity at some point over the next few weeks or months, it certainly looks very much a realistic possibility of that.
Look, you mentioned the Reserve Bank of India. I didn't hear they were defending the rupee, but last week, as you know, of course, they did an intermeeting rate hike. Do you think that was a currency-related thing?
Well, it's certainly an inflation-related thing. As you mentioned, they surprised markets very much by sticking up their repo by 40 basis points to 4.4%. And it's almost certainly the case, it's a reflection of the fact that inflation has gradually accelerated and certainly accelerated more quickly than expected. A bit like the US will get another set of inflation numbers soon.
That was an intermeeting. That was an intermeeting. How often do they do intermeeting rate hikes?
I think it's fairly unusual. It's not unprecedented for them to do it, but it's certainly unusual. But it does seem that they've been caught out by just how quickly inflation's been rising. So tomorrow on Wednesday, we'll get the April inflation data. The market's right, that's going to be up at what, 7.4%. So
This is India. Yeah, that's
this is
but
India.
they have a 6% top to their target. Right.
That's right, and that's the upper limit. Ideally, they wanted
Yeah.
at 4%. So it's a bit like everybody else, I think. You've got your currency going down, inflation's going through the roof. What you're going to do now? Their first step in this case is to intervene, try and support it. If that doesn't work, we may have to see another interest rate hike coming through, perhaps rather before they actually wanted to to deliver that.
But the ECB is kind of hamstringed in a way by their own forward guidance. They're stumbling over their own forward guidance. They can't react fast enough.
Well, yeah, as forward guidance stands at the moment, that's perfectly true. They did amend their forward guidance earlier on this year to give them the scope to raise interest rates over the second half, but we don't have to go back very long ago before we had the likes of Christine Lagarde, the ECB president, saying an interest rate hike this year was extremely unlikely. But I think the fact that the numbers, the inflation figures have been so high means that, look, this is a credibility issue now. We had to be seen to be doing something. And looking at the likes, the PPIs and everything else, the forward-looking indicators of HICP inflation, they're all very much heading in the wrong direction. You've got some members now with producer price inflation running at over 40% year on year. So some really frightening numbers out there. On a similar note, but again, as you were saying earlier, it's a very complex time trying to interpret some of the numbers. The UK is very much a case in point at the moment. As people probably saw, Bank of England hiked interest rates again by 25 basis points last week. But on the MPC, the Monetary Policy Committee, 3 of the 9 actually wanted to see a 50 basis point hike. And I must say, when that first came out, I thought, well, the pound should react quite well to this. However, we've seen the pound being hit quite badly. And the reason for that is that although we did get the interest rate hike and the possibility of perhaps more to come, the Bank of England has significantly downgraded all its economic projections with regards to growth. So we're now talking about probably no growth at all in the second quarter, and they're talking about 2023 growth at minus 0.25%. And indeed, by the end of their 3-year forecast horizon, they expect the economy still to be 2% lower than it was a couple of months ago. So there's been a huge turnaround in the way the UK economy is being seen, to the extent that although interest rates are widely expected to go still higher, there's going to be an expectation that it might have to come off quite sharply and perhaps sooner rather than later.
Now, how much is domestic policy in the UK to blame for this? And I'm talking about, your electric fees and all those kinds of things. Is that what's specifically at play here in the UK?
It is part of it, but I guess you can say that in many ways, UK inflation at the moment is pretty well tracking what we're seeing coming out of the Eurozone. So yes, we've had the way the energy sector is structured over here. You do get every 6 months, you typically get an adjustment in domestic energy prices, which will have an immediate impact on actual inflation. But as we stand at the moment, inflation, as of the March date, we're talking about a 7% rate. So we're kind of moving pretty well in line with the Eurozone. So it's not a major change from that. But from the way the real economy is going, yes, the government over here is desperately trying to pull back some of the funds it spent during the COVID crisis. We had a big increase in national insurance coming through in April, the last of the budget measures. There's been very little sign of any kind of major offset to what's going on the cost of living coming out of the government in recent weeks. So the UK economy has been hit by a number of headwinds at the moment. And indeed, I guess you talk about you've got strong consumer demand on your side. Well, in the UK, retail sales have fallen in 3 of the last 4 months and down in 4 of the last 6. So there's a real concern now that the bank's talking about 0 growth in the second quarter. If anything, it could even be a negative number. If we get that, we could even see a recession in the UK as soon as this year.
Well, I mean, is it plausible? I don't want to bring up anything unpleasant, but is it plausible that Brexit has anything to do with this?
I'm pleased you asked me about Brexit. Yes, because I did want to mention that before we prattle on for too long. But most of the evidence coming out from the Brexit data, and as you mentioned, it is difficult to disentangle some of these from COVID and everything else. So you've got to be a bit careful with it. But they do suggest that Brexit is still having an impact. So from the German numbers, which came out the other week from their merchandise trade figures. German goods exports to the UK were down 3.9% on the month in March, and they're down, 0.3% on the year. Now, compared with March 2019, exports to Britain were down 27%, even though Germany's overall exports grew by 16%. In fact, the UK was the only major German trading partner to see a contraction in exports, compared with March 2016, so 3 months before the Brexit referendum.
How are the UK exports to Germany? Are they also in contraction?
They're also struggling, yeah. And
so it's limiting, or it's constraining, or it's constricting cross-border activity?
Very much. I think, trade flows across the channel between the UK and continental Europe have, however you chop this data up, have been hit by Brexit. And indeed, even the Bank of England in their report last week, mentioned that Brexit was having a dampening impact upon overall levels of economic activity. So there's a lot of sort of hits coming through to the UK economy at the moment, which, as we can see from where the pound's come off so sharply over the course of the last week or so, really starting to get investors unnerved now.
Wow. Is there a political component, real quickly? Is there a political component? With the Tories in power, and they have to be, happy about Brexit, but what about the general infrastructure of the economic community, or not the infrastructure, but the balance of the economic community and policymakers and things?
Well, the balance certainly of businesses are that most of them are none too happy with Brexit. They didn't want it in the first place. And from the queues, the miles and miles of queues on the main motorways going down to the UK major ports like Dover, they're extremely unhappy with what's going on. A lot of the checks which are supposed to be being put into place, once Brexit actually happened, haven't gone through fully. There's a whole load of red tape and paperwork which is supposed to be removed, but in actual fact seems to have got worse than ever. So, it may be longer run Brexit works, but certainly on a short-term basis, what we've seen from so far is caused damage to the UK economy, and that's going to be around for a little while longer yet. Right, let me try and quickly round off some of the other bits and pieces. Mentioned intervention now at the RBI, Swiss National Bank. On previous podcasts, we've pointed out that the intervention from the Swiss National Bank, due to the unwanted strength of the Swiss franc, has been relatively limited. Well, they've now stepped that up. And last week we saw 6.5 billion Swiss francs of sales from the Swiss National Bank, which is the heaviest intervention we've seen from them since May 2020. And as I mentioned, that's to stop this Swiss franc, which is benefiting from Ukraine and safe haven flows and the move against from risk aversion, which has been one of the principal beneficiaries, as you'd expect in Europe. And it does seem now that this euro Swiss franc parity level is just about as far as they're prepared to let the cross rate go, and that's now becoming some kind of a floor. So that's something to keep an eye on. They have certainly managed to turn around the currency a little bit over the course of the last few days, but it's still very close to parity. It's about 5 cents or so above it at the moment, so it's still threatening to take that out. So it's going to be interesting to see what happens with that one. Well, to mention quickly, Canada, Mark mentioned the US employment report. Of course, we had the April one out of Canada last Friday, which again, although the payrolls were a little bit softer than expected, overall tone still very strong. It certainly suggests there's more interest rate hikes to come out of Canada, Bank of Canada, over the course of coming months.
Yeah, the Canadian economy is doing, like you're talking about the Swiss economy, but the Canadian economy is doing really well. Energy prices are helping them a great deal.
Yeah, that's right. And of course, they really are one of the beneficiaries. And I guess from the market perspective, you think that the Canadian dollar really ought to come out of this little scenario quite nicely. In contrast, of course, to what we're seeing out of China, Mark mentioned about the COVID issues out there. Shanghai, normally the world's biggest port, it's now in its 7th week of lockdown. We've had pandemic curves being tightened in Beijing. And the bottom line of all this little lot is that, yes, China is certainly slowing, but what it's doing in terms of in sales of its goods, it's just simply adding to all these supply chain disruptions we've had for so many months now.
And this is a big risk because they don't seem that they only have a handful of cases, and I just read this story this morning that they're increasing restrictions. It wasn't in Shanghai, or was it in Beijing?
Beijing, Shanghai's been under lockdown for 7 weeks.
The COVID's going to win. I mean, there's just, if you're just talking about a handful of cases and they're not going to allow any cases, if they're going to persist in this, they're going to drag everybody down. I just wanted to throw that out.
Yeah, I think you're right. But I think for the Chinese authorities, of course, they're stuck with it now. They'd lose face if they were to change tack on that. So they're going to stick with it for presumably as long as they have to. But yeah, I think you're right. Right. Quickly then, Reserve Bank of Australia, they tightened by 25 basis points last week as well. That was a bit stronger than expected. And of course, they were one of the most dovish central banks. So that tells you again about the general shift in sentiment amongst all the central banks, or pretty well all the central banks, towards tightening at the moment. And I guess hopefully that's pretty well it. Anything else from your side, Mark?
No, I guess but I think we kind of covered everything. But I think China is a risk here. So
It is. I think you're right.
Yeah, there's nothing that democracies can do. So what can you say?
There's so many different factors pulling significantly in different directions. So that just looking at how the financial markets responded to the Fed's move last week, and that was really quite remarkable.
One day one thing, another day another thing. Yeah.
And again, it just shows you just how uncertain investors in general are about what the heck they're supposed to be doing at the moment. Right, so it is then a very complex picture for investors and central bankers to dissect, but as ever, the data will be key. So as we always say at the end of our podcast, make sure you keep yourselves fully up to date with all the major economic statistics, policy moves, and other key market moving events in Econoday's global economic calendar. On behalf of Mark and myself, thanks as ever for listening, and we hope to see you again next time. Bye for now.